For Wall Street Media, I'm Mike, I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
That's what we do. We bring you the best of the best. Gave you Todd Sullivan 2 days ago, calling the market rally. Been telling you to follow Canal on StockTwits. He just made a 55% gain trade this morning.
Oh, nice.
I picked up a couple dollars on BGZ this morning, pre-market, and then right at the open. And now we've got Rich Gordon, who is the most polished, elegant, wonderful man. Everybody respects him, and we're bringing him to you. Take a look.
Yeah, we got Rich Gordon, fixed income market strategist of Ecovio Corporation, ticker WFC. He discussed further job losses and the rising unemployment rate. He also analyzes the reason for the IMF to expect world GDP to contract for the first time since World War II.
What he says is, don't destroy the banking system in order to save it. Rich Gordon's a genius and highly regarded. You need to watch this.
Let's take a look at the clip.
The economic news has been simply awful. The payrolls report on Friday showed a further jobs loss of 651,000, and the unemployment rate rose to over 8%. Perhaps a better indicator of the rising misery level among workers in the U.S. is the index of unemployed and underemployed workers, which has risen by over 600 basis points in the past 12 months. It represents a stunning reversal of fortune for the world's largest economic engine and the primary reason that the IMF now expects world GDP to contract for the first time since World War II. The implications of this extended downturn and period of hardship are the following. First, consumer confidence in spending has fallen off a cliff. People are worried about keeping their jobs or finding a job or making do with a lower income, and they've been numbed by the prospect of having to replace a significant portion of their retirement savings, which has seemed to evaporate in a short time during the past year. As asset values and wealth have declined during this nasty downturn, the one constant has been that the value of each dollar of uninvested capital has increased exponentially. In dramatically slicing their discretionary expenditures, individuals are mirroring the behavior of leveraged corporates, many of which are now managing their businesses in an austerity mode, and they've slashed dividends, payroll, and compensation since the beginning of 2009. We expect this deleveraging trend to continue throughout the year, which should present an extremely challenging environment for risk assets. Second, the key to determining when the stock markets will bottom and begin to stabilize is to assess when a large number of retail investors will capitulate and sell into an inherently weak market, allowing a bottom to form. I think that we've already entered the capitulation phase, which should play out during the rest of the first and the second quarter of 2009. We note that outflows from equity mutual funds have accelerated over the past few weeks, as people cut their losses and move to the sidelines. Consider the plight of the individual investor, who has seen the value of their retirement savings cut in half. While a 45-year-old person faced with this loss might, quote, hang in there and count on recovering a significant portion of that loss over the next 15 years, a 60-year-old person might not feel like they have that luxury. They're more likely to sell into the weakness in order to preserve what retirement wealth they still have. Accordingly, we think that the stock market remains vulnerable to one more significant leg lower. The weekly price chart shows that the next level of support is just above 600, and I can easily see a test of that level before the middle of the year, which represents a further decline in stock prices of more than 11% from here. Through there, we see little technical support until the mid-400s. Third, corporate bond valuations will remain under pressure until the stock market stabilizes. The performance between fixed income credit assets and the stock market has begun to recorrelate over the past few weeks because the recent price gains in bonds are proving to be unsustainable given the deteriorating fundamental economic climate. High-yield bonds in particular look very vulnerable in the face of further declines in the equity markets. The R-squared between stocks and high-yield bonds has been 92% since the beginning of 2009, and a test of technical support just above 600 on the S&P would imply further losses on the high-yield index of about 5 points. Finally, the rhetoric from members of Congress, as well as from the administration, has been conflicting and confusing. I think it's undermining the benefits of the capital infusions and fiscal stimulus from the series of federal bailout programs. The clearest indication of this dynamic is in the credit spreads of the major banks. The chart shows that the CDS spreads of the 4 largest banks in the U.S. have widened by 210 basis points over the past 4 weeks. This is the result of investors reacting to aggressive rhetoric about nationalizing these institutions and potentially causing losses to run far up the capital structure. Apparently, Senators Schumer, Shelby, and Graham didn't learn much about the amplifying effects of credit write-offs in highly leveraged, systemically critical banks and financials like Lehman Brothers and Washington Mutual. What they'll find is that nationalization that results in large-scale write-offs of senior and even mezzanine or hybrid debt of these institutions will cause financial companies of all types that are still solvent and operational to incur huge actual write-offs. This, in turn, will deplete the capital they've received from the government and result in a near-complete seizure in lending that could make the current supply of credit look abundant. And that would mean that the S&P could fall through to the second technical support area in the mid-400s, more than 30% lower than Monday's closing level of 676. I don't think that it makes a lot of sense to destroy the banking system in order to save it.
Fabulous stuff, man. Love Rich Gordon, and I'm glad that we have him to bring to you.
Yeah, perfect. We're here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.